All right, let's jump right in. Welcome to this Masterclass Explainer where we're going to completely unpack AT&T. We are acting as an expert investment analyst today, and we're evaluating the company's first quarter 2026 financial results using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. We're going to strip away all the market noise and look purely at what the cold, hard numbers tell us.
Here is our analytical roadmap for today. We'll start with an AT&T snapshot and apply the Buffett lens. Move right into Peter Lynch and Benjamin Graham, build out a strict discounted cash flow valuation, explore some alternative models, and finally wrap it all up with a synthesis and final recommendation.
Section 1. AT&T Snapshot and the Buffett Lens. Let's go searching for that economic moat.
So, taking a look at the raw data right now, AT&T is trading at $21.07, with a massive $143 billion market cap. It's actually showing a very low price-to-earnings ratio of just 6.94. You know, the company just reported their absolute best first quarter ever for advanced connectivity internet net additions. So, their core business of getting people connected on fiber and 5G, it's humming along beautifully.
Okay, let's put on our Warren Buffett classes and run through his checklist. Do they have a moat? Yes, for sure. It operates in a huge telecom oligopoly with the nation's largest converged network. Consistent earnings? Absolutely. They pulled in $4.2 billion in income from continuing ops just this past quarter. Return on equity is sitting at a very respectable 13.4%, based on roughly $125 billion in equity. And owner earnings, which is what Buffett really truly cares about, are excellent, with management projecting over $18 billion in free cash flow for the year. But take a look at that debt line.
And this right here perfectly illustrates the massive tension for a value investor. You have this incredible $18 billion cash-generating machine, but it is weighed down by over $131 billion in long-term debt. Buffett famously loves businesses that need very little capital to grow and have spotless balance sheets. AT&T, on the other hand, needs constant, massive capital expenditures, like $4.9 billion just this quarter alone. Honestly, that mountain of debt would likely give the Oracle of Omaha serious pause, even with that juicy cash flow.
Section 2. The Peter Lynch Lens. Time to categorize the giant.
Based on AT&T's guidance of low single-digit service revenue growth, combined with its massive, sprawling size and a rich regular dividend yielding 5.39%, AT&T is the absolute textbook definition of what Peter Lynch calls a slow grower or a stalwart. You definitely aren't buying this stock expecting it to double overnight, right? You buy it for the yield and the downside protection.
Now, the specific metrics here present a really fascinating mixed bag. Lynch loves a good PEG ratio. That's price to earnings divided by growth. With a PE of 6.94 and Q1 adjusted EPS growth of 11.8%, the PEG comes in at roughly 0.58, which is fantastic, highly favorable. However, Lynch demands a strong balance sheet. AT&T's current ratio is 0.92 and its quick ratio is 0.87. Anything under 1.0 means the company might actually sweat a bit covering short-term liabilities. Add in the fact that institutional ownership is super high at 57.10%, and remember, Lynch loves under-the-radar stocks. He would likely rate AT&T as a hold or maybe even a sell.
Section 3. The Benjamin Graham Lens. Let's think like a defensive investor.
Graham's checklist is famously, notoriously strict. AT&T easily passes adequate size, it passes earnings stability, and boasts a flawless recent dividend record, paying out $1.11 annualized. The PE of 6.94 is beautifully under Graham's max threshold of 15, and the price-to-book ratio of roughly 1.17 is well under his limit of 1.5. But once again, it fails the financial condition test. Graham wants to see a current ratio of at least 2.0, and AT&T is sitting way down at 0.92.
So, the real kicker here is what happens if we just run Graham's intrinsic value formula anyway. If we plug in the numbers, taking the square root of his standard 22.5, multiplying it by the projected EPS of $2.30, and then by the book value per share of $17.90, we get an intrinsic value of $30.43. At the current trading price of $21.07, that offers an incredible 30% margin of safety. So, if a Graham-style investor could somehow stomach that poor current ratio, this stock looks absolutely dirt cheap on a pure earnings and book value basis.
Section 4. Discounted cash flow valuation. Time for the hard math.
A DCF model values a company based purely on the actual cash it's going to produce in the future. Management is forecasting $18 billion in free cash flow for 2026. However, first quarter free cash flow actually dipped nearly 20% year over year, down to $2.5 billion, mainly because they are spending so heavily on fiber investments. Because of this dip, we have to make a very conservative assumption here. We're modeling 0% cash flow growth for the next 5 years, a mature 1% terminal growth rate, and an 8% discount rate, or WACC.
Let's see how these assumptions actually play out in a sensitivity table. Because AT&T carries roughly $126 billion in net debt. That's their total debt minus their $11.9 billion in cash. Any tiny change in our assumption swings the equity value wildly. If the discount rate just inches up to 9%, the stock is only worth $10.60. But if it drops to 7%, suddenly it's worth $26.50. That massive debt load acts like a crazy leverage magnifier on the valuation.
So sticking to our base case assumptions of an 8% WACC and 1% terminal growth, we calculate the enterprise value, deduct that massive $126 billion in net debt, and it leaves us with a DCF fair value of exactly $17.21 per share. By this super strict cash metric, the stock is currently overvalued.
Section 5, Alternative Valuation Models, taking a look at yield and comparables.
To answer this, we can use the dividend discount model, or DDM, which values a stock solely based on the present value of its future dividend payouts. Because, let's be real, for a huge chunk of retail investors, securing that 5.39% dividend is literally the only reason they own the stock in the first place.
When we run the DDM, assuming an 8% cost of equity and a tiny 1% dividend growth rate, mostly because the dividend hasn't meaningfully grown in years, the model spits out a pretty pessimistic fair value of $15.85. And wow, this heavily contrasts with the Wall Street consensus target, which sits way up at $30.23. Analysts are looking at comparables, seeing that low 6.94 PE ratio, and predicting a massive 43% upside based on earnings multiples alone.
Section 6. Synthesis and Final Recommendation. Let's bring this all together.
Looking at these results side by side, we see a massive tug of war. Earnings-based models, like the Graham formula and Wall Street comparables, suggest AT&T is heavily undervalued, pricing it right around that $30 mark. But the cash and debt-based models, like our DCF and the dividend discount model, suggest it's actually overvalued right now, pricing it much closer to $16 or $17. Blending all our gurus together, the final verdict is pretty clear. AT&T is a solid hold at $21.07. Look, the strengths are undeniable. They have an incredible oligopoly moat, phenomenal $18 billion cash generation, and excellent 40.6% EBITDA margins in advanced connectivity. But the risks are equally glaring. A suffocating $131.5 billion in long-term debt, a weak quick ratio of 0.87, and flat dividend growth. For a disciplined value investor who requires a true margin of safety across all metrics, the target entry price really sits closer to $16.
Ultimately, what this explainer reveals is that with AT&T, you are buying into a brilliant, high-margin converged connectivity network that just happens to be anchored to a historic mountain of debt. Management is actually executing really well right now, delivering on their 5G and fiber strategy, but it's the balance sheet that is dictating the stock price.
And that leaves us with one final question you have to ask yourself as a focused learner before ever adding AT&T to your portfolio. Is that 5.39% yield today truly worth bearing the weight of a $131 billion debt burden tomorrow? Thank you so much for joining this explainer. Keep analyzing, keep digging into the data, and most importantly, keep questioning the numbers.